Welcome to the 8th video relating to property, plant, and equipment. In the first 6, we had looked at the acquisition cost of the asset. In the 7th one, we looked at subsequent expenditures. And in this one, we are going to look at disposal of an asset. So when we dispose of an asset, we have to make sure that we depreciate the asset all the way until disposal, unless mentioned otherwise in the problem. And then we can take the asset off our books. So let's take a look at an example where we have different ways in which an asset may be disposed by a company. So in this example, they're telling us that on December 31st, 2020, we have a machine with a book value of $940,000. The original cost is $1.3 million. Accumulated depreciation is $360,000. Depreciation is computed at the rate of $60,000 per year using the straight line method. They've given us 3 different cases, 3 different scenarios, all dealing with the same asset. They want us to treat each of these as independent situations. So we'll do 3 separate journal entries, and they've told us to make sure that depreciation entries are made to update the book value of the machine prior to its disposal, which means we have to do a journal entry before we dispose of the asset. So let's see what we have over here. In the first case, they tell us that on August 31st, 2021, a fire completely destroys the machine. In insurance settlement, we get $430,000. Assume that the settlement was received immediately. So this happened immediately. So we're going to do the journal entry on the date of the fire first, August 31st, 2021. First thing I need to do is calculate the depreciation from January 1st, 2021 through August 31st, 2021. So in our journal entry, I know it's depreciation expense debit, accumulated depreciation credit. This is going to be for 8 months. So $60,000 times 8 over 12. I'm going to have depreciation of $40,000. Now, I'm going to take the asset off my books to dispose of it. So it's going to be accumulated depreciation debit. And I'm going to credit the asset. I know the original cost of the asset is $1.3 million. Accumulated depreciation was $360,000. I did another $40,000 in this journal entry, leaving me with $400,000 in the accumulated depreciation account. I also got $430,000 from the insurance company. So that's cash debit, $430,000. That leaves me with a loss. The balancing figure is loss due to fire, and I'm going to put that in parentheses. That is the balancing figure is $470,000. So to take the machine off the books, I had to first depreciate it up to this point and then find out what the loss in this transaction is in the disposal of this asset. So now let's look at the second independent situation they're telling us that the first one did not happen. Let's take a look at this one. On April 1st, 2021, we sold the machine for $1,040,000 to another company. So this is a happier situation. I'm making a sale. Let's see what happens over here. First thing is I need to do the depreciation for how many months? 3 months. January 1st through March 31st. So I have the journal entry where I have depreciation expense debit, accumulated depreciation credit, $60,000 per year multiplied by 3 over 12 to give me the 3 months depreciation. That works out to $15,000. Okay, now I need to dispose of the asset. So accumulated depreciation will be debited. The machine will be credited. Now I know the machine is $1.3 million. Accumulated depreciation was $360 plus 15 gives me accumulated depreciation of $375. I sold it for $1,040,000. So I got cash, and that is $1,040,000. So I have the debits are in excess of the credits. So I have a gain on sale. And the gain on sale is a balancing figure. Again, let me put that in parentheses that it's a balancing figure. Basically, I sold it at more than the book value, and that again is $115,000. Now let's look at the last one. In the last case, the company has donated on July 31st. The company donated the machine to Mountain King City Council. The fair value of the machine at the time of donation is estimated to be $1,100,000. We always need to bring it to fair value in case of a donation because that asset, I need to recognize the appropriate gain or loss as if I sold it. So first thing I need to do is the depreciation journal entry. So let's start out with that first. July 31st, that's all the way through end of July is 7 months. So $60,000 times 7 over 12 will give me $35,000. I'm giving up this asset, accumulated depreciation debit, machine credit. Again, machine is $1.3 million. Accumulated depreciation, 360 plus 35 will give me 395. Okay. Now, this 1.1 million fair value of the asset, what I could have gotten in cash, I just gave it away. That number is going to be the contribution expense, $1.1 million. I write it off as an expense in my books, not as a loss, but as an expense. I just gave it up. Okay. I would have had a gain on disposal of 195. Okay. So how is that calculated? 1.3 million minus 395 is a book value. Book value, and I compare it to the fair value of the asset. And that tells me that I could have actually sold it at a gain of 195. So I recognize the gain of 195, but this 1.1 million fair value, that's a contribution expense. Okay. So in this case, again, the gain on disposal is going to be the balancing figure. So again, a common theme that you should have seen over here in all of these cases. Loss due to fire is a balancing figure. The gain on sale is a balancing figure. Gain on disposal is a balancing figure. In all of these cases, you've seen there's a pattern to it in terms of how we do the journal entries. That's a plugged number over there. Again, we always know the original cost of the asset. The accumulated depreciation, you need to calculate it all the way up to the point you had the asset just before disposal, up to that point of time. And then you see whether you got something in this transaction just before the disposal. If you did, you need to recognize it. In this case, you got cash before the asset was completely, the asset was destroyed and I had to take it off my books. In this case, I got cash from the sale. And here I didn't get anything, but it's a contribution expense, so it's going to lower my net income. And I had a gain on disposal. But again, I had to recognize the gain before I take it off my books. So different ways in which we have an asset leaving our company. And when it leaves our company, we need to take it off our books. It does affect my balance sheet. And at this point of time, it's going to affect my income statement as well. Gains and losses are going to be listed in the income statement. So these are various topics we have seen as it relates to property, plant, and equipment. We start with the acquisition. We looked at subsequent expenses and the disposal of assets. In the next chapter, our focus is going to be on depreciation. So with that, we conclude this particular video.